Mr. President, I rise to discuss S.2155. It's called the Economic Growth, Regulatory Relief, and Consumer Protection Act. Now, you'd think from the title that I would be all for it. But as one who went through the drop in the economy when we were on the brink of collapse, I believe this is a very bad bill. Let me take you back for a moment to that time. Banks were teetering, and over 300 would fail in the next 3 years. For perspective, only 3 banks failed in the year of 2007. Unemployment was skyrocketing. We lost $19 trillion in household wealth. Americans lost nearly 9 million jobs. In my state, California, more than 2 million people were unemployed. 3.5 million mortgages were at risk, and nearly 200,000 people filed for bankruptcy. Now that the economy is recovered and unemployment has decreased from its high point of 10% during the crisis, I worry that my colleagues have forgotten the magnitude of this crisis. I simply cannot. I remember sitting in caucuses, hearing from our top financial officials about the potential for a total collapse of our economy. Treasury Secretary Timothy Geithner testified to the House Financial Services Committee, and I quote, "Our financial system failed to do its job and came precariously close to failing altogether," end quote. That is not an exaggeration, Mr. President, for those of us that were here, who listened to the economists, who heard what was happening. We feared a total collapse. And personal conversations I had with these economists carried the most dire warnings. We should never get close to that point again. Congress spent more than $400 billion on something labeled TARP, Troubled Asset Relief Program, to help stabilize the economy. It was very controversial at the time, but we have since recouped more than we spent on that bank program. Congress then passed the Dodd-Frank Wall Street Reform and Consumer Protection Act in 2010, putting in place policies to prevent another financial crisis, including strong protections on the largest banks. Now, just 8 years later, how quickly we forget we are considering loosening these protections. Have we forgotten the lessons from 10 years ago and the devastating consequences for American families? As with any bill we pass, I'm open to looking at how it's been implemented and making adjustments as needed. For Dodd-Frank, I agree that community banks and credit unions shouldn't be regulated the same way as the largest banks in the country. I'm open to adjusting some of these regulations for them. But this bill simply goes too far. It goes beyond targeted relief for small institutions. The nonpartisan CBO, Congressional Budget Office, says the probability of a large bank failing or another financial crisis will go up if this bill is enacted. One provision I'm particularly worried about would roll back regulations and supervision for banks with assets between $50 billion and $250 billion. These aren't just small community banks we're talking about. Instead, this would apply to some of the largest banks in our country. Paul Volcker, the former chairman of the Federal Reserve, wrote that countrywide, National City, and GMAC were all below $250 billion and required, this is a quote, required billions of dollars in official capital assistance and debt guarantees either for themselves or their inquiring institutions, end quote. And here's what Phil Angelides, who served as chairman of the Financial Crisis Inquiry Commission, said about this particular provision, and I quote, "The bill's provisions to lift the asset threshold for enhanced prudential standards and supervision from $50 billion to $250 billion would substantially reduce oversight over 25 of the 38 largest banks, including institutions over $100 billion in assets that were deemed too big to fail in 2009. A number of financial institutions with less than $250 billion apparently triggered the need for bailout assistance during the crisis. And history has shown time and time again that the failure of financial firms that are not among the largest mega banks can pose systemic threats to financial stability. In addition to weakening these requirements, the bill could also weaken capital requirements for even the largest banks. Sheila Bair, former chair of the Federal Deposit Insurance Corporation, said this could lead up to a 30% capital reduction at some banks. Just think of that. She also raises a question that we should all take a moment to reflect on. Why does Congress want to start designating banking activities as low or no risk when expert financial regulators were so wrong prior to the crisis? Finally, this bill would amend the SAFE Act that I authored to ensure that mortgage brokers and lenders meet minimum standards. This was necessary to curb abusive lending practices we saw leading up to the financial crisis, in which many consumers were taken advantage of through predatory lending. This was a serious problem in California. Between March and June of 2008, 406 defendants were charged in 144 mortgage fraud-related cases, and approximately $1 billion in losses were attributed to these fraudulent acts. The SAFE Act created a new system of registration and licensing that included background checks, education requirements, and testing to assure that mortgage brokers and lenders could meet basic standards. The bill before us, interestingly enough, would allow mortgage loan originators to operate without a license for up to 120 days if they move from a bank to a non-bank or across state lines. Allowing this transition period without ensuring that lenders have passed the licensing test we required in the SAFE Act weakens the protections we put in place for consumers. Before I conclude, I want to say that I appreciate this is a bipartisan bill that's gone through banking. I also understand the interest in ensuring regulations are appropriately tailored to the size and activity of financial institutions. But I'm really worried that members here have become too comfortable in our economic recovery and have forgotten where the path of deregulation ends. I oppose this bill because it simply goes too far in deregulating some of our largest institutions and weakening the protections we put in place to prevent another financial crisis. If we don't learn from past failures, we are doomed to repeat them.